Agree Realty Corporation (ADC) is fundamentally positioned as a premier operator within the necessity-based net lease retail segment, characterized by exceptional portfolio quality and superior financial strength. The core investment proposition rests on ADC's ability to deliver defensive, reliable income irrespective of macroeconomic headwinds. This resilience is anchored by an industry-leading tenant credit profile, with 67% of its annualized base rent derived from investment-grade IG tenants, reaching 67.8% historically. This high exposure to creditworthy tenants minimizes default risk and ensures the stability of its long weighted average lease term (WALT) of 11.8 years. Financial stewardship is a key differentiator. ADC holds an A issuer credit rating from Fitch Ratings, placing it among a select group of the most financially secure U.S. publicly listed REITs. This strong credit profile has enabled aggressive yet highly disciplined capital deployment, evidenced by management raising the full year 2025 investment guidance to a range of $1.5 billion to $1.65 billion. This growth translates directly into robust earnings, as demonstrated by the 7.2% year-over-year increase in Q3 2025 adjusted funds from operations. Furthermore, the company successfully managed to substantially deleverage its balance sheet, achieving a pro forma net debt to recurring EBITDA ratio of 3.5x, a significant improvement from prior metrics of 5.0/4.3x. 1.2. Investment recommendation and target price rationale. While the current implied valuation multiple of 16.87x price to AFFO, PAFFO, suggests the stock is not undervalued, the analysis concludes that ADC warrants a premium valuation relative to its peer group due to its unique combination of structural resilience and best-in-class execution. The high credit quality, proven management discipline, including the strategic ability to pass on overpriced deals to protect margins, and the use of diversified growth platforms for superior asset creation, ensure the durability and high quality of future AFFO growth. The ability to aggressively expand the portfolio while simultaneously strengthening the balance sheet confirms ADC's status as a defensive growth stock. The consensus average analyst price target is $82.21, implying a substantial capital appreciation upside exceeding 12%. This target is supported by a justified valuation multiple expansion driven by continued operational success. Target price rationale. The $82.21 target reflects an appropriate premium for industry-leading credit quality, balance sheet integrity, and sustained AFFO growth trajectory. The net lease retail REIT sector landscape and competitive positioning. 2.1. Sector dynamics, interest rates, cap rates, and cost of capital. The net lease sector operates under significant macroeconomic pressure, with interest rate increases posing the primary risk factor, as explicitly noted by ADC. The cost of capital for all real estate investors is inherently linked to interest rate movements, reflected in benchmarks like the U.S. 10-year T-note futures. A critical dynamic currently affecting the market is the relationship between interest rates and capitalization rates. A cap rate, calculated as net operating income divided by asset value, assesses the yield of a property. Traditionally, when the cost of borrowing rises, cap rates follow suit. However, the current environment has seen a dislocation where net lease cap rates have remained relatively sticky, only rising approximately 50 basis points to 5.5% as of Q3 2022. This situation has led to the compression of the spread between the yields generated by acquired properties, cap rates, and the cost of debt used to fund those acquisitions. For highly leveraged investors, this leads to negative leverage, where the yields on commercial real estate are lower than the interest rate on the corresponding loan. This dislocation has strained the market, widening the bid-ask spread and dramatically slowing transaction volume for many leveraged players. ADC is structurally insulated from the acute pain of negative leverage due to its conservative capital structure. The company funds its investment activities primarily with equity, approximately 75%, and only 25% long-term debt. Combined with its A- credit rating, which provides access to the lowest possible cost of debt, ADC is not constrained by high borrowing costs in the same way its more leveraged peers are. This superior access to low-cost capital allows ADC to maintain accretive acquisition spreads and continue deploying capital at a massive scale, 1.5B target, while others are forced to slow down. 2.2. Competitive analysis. Scale and quality. ADC versus NNN-O. ADC operates as a mid-cap retail REIT with a market capitalization hovering between $8.38 billion and $8.39 billion. This places it slightly larger than National Retail Properties, NNN, valued at approximately $7.72 billion, but significantly smaller than the dominant sector player, Realty Income, O, which boasts a market capitalization of $53.01 billion. In comparison to NNN, ADC demonstrates superior recent stock performance, achieving a year-to-date price gain of 6.714% against NNN's 4.388%. Furthermore, ADC maintains a cleaner balance sheet, carrying less total debt, $3.27 billion, than NNN, $4.65 billion. A comparison of conventional GAAP metrics, such as the price-to-earnings ratio, PE, illustrates why these metrics are unreliable for REIT valuation. ADC's PE ratio stands at 42.61, substantially higher than NNN's PE of 19.45. This disparity arises because GAAP earnings deduct real estate depreciation, which is non-cash, and fails to reflect the true cash flow generated by appreciating real assets. Therefore, institutional analysis correctly shifts focus to non-GAAP metrics, predominantly PFFO and PAFO. Agree Realty, ADC, Portfolio Deep Dive and Income Durability. 3.1. Tenant Credit Profile and Income Stream Quality. ADC's portfolio composition is the foundation of its defensive investment profile. The company maintains an industry-leading investment-grade IG exposure, currently at 67%, with a historical figure reaching 67.8% of annualized base rent. This high concentration of creditworthy tenants translates into a weighted average credit rating for the portfolio of BB+. This profile is critical because it ensures the reliability of the long-term, fixed rental payments, effectively making the income stream highly predictable and bond-like. Risk is further mitigated through low tenant concentration. The company's top 3 tenants account for only 15.2% of ABR, indicating robust diversification across tenants and retail concepts. Management has also shown prudence by strategically reducing exposure to certain traditionally weaker retail sectors, specifically mentioning a decrease in reliance on dollar stores and pharmacies. 3.2. Lease duration, occupancy, and operational efficiency. The duration of the company's lease contracts ensures cash flow longevity. ADC maintains a strong weighted average lease term of 11.8 years. This long WALT provides exceptional revenue visibility, significantly exceeding the 10-year duration characteristic of the general Bloomberg BBB Composite Index, further demonstrating the superior stability of its contractual revenue. Operational management is reflected in near-perfect occupancy. The portfolio occupancy rate stands at 99.7%, confirming the high quality and desirability of the underlying real estate assets. Geographically, ADC operates across 48 states, ensuring that diversification protects against localized economic downturn. No single state contributes more than 8% of the total ABR. 3.3. Specialty Portfolio Analysis, the ground lease segment. A unique and valuable element of ADC's portfolio is its substantial ground lease segment, which contributes 13.5% of the total ABR. This segment features an even higher level of credit quality than the overall portfolio, with 87% of ground lease tenants classified as investment grade. The ground lease structure provides a powerful, often under-modeled, long-term economic advantage, the reversionary interest. ADC owns the underlying land, while the tenant typically finances and constructs the building improvements. The critical legal term is that upon the lease expiration or tenant default, the building and all improvements revert to ADC free of charge. This mechanism offers the company an embedded equity option and acts as a significant hedge against long-term inflation. It represents a potential deferred capital gain that standard net present value calculations derived from rental income fail to fully capture.
IV. Financial Performance and Balance Sheet Integrity. 4.1. Core Earnings Analysis, FFO and AFO. ADC consistently demonstrates strong organic and acquisitive growth, leading to above-peer sector earnings performance. In Q3 2025, the company reported core funds from operations (FFO) of 1.09 per share, alongside adjusted funds from operations (AFO) of 1.10 per share. This AFO figure surpassed analyst consensus by 0.02 cents and translated into robust year-over-year AFO growth of 7.2%. The company has a strong track record of operational delivery, having exceeded consensus FFO estimates in 3 of the last 4 quarters. Confidence in future performance led management to increase its full-year 2025 AFO guidance to a range of 4.31 to 4.33 per share. Using the midpoint of 4.32, this guidance implies a solid 4.4% growth rate over the prior year. 4.2. Leverage and Credit Profile Assessment. The superior quality of ADC's balance sheet is underscored by the A issuer rating assigned by Fitch Ratings. This credit profile is highly valuable, as it substantially lowers the company's weighted average cost of capital, making high-volume accretive acquisition execution more achievable than for lower-rated peers. A central achievement has been the sustained deleveraging effort. The company successfully reduced its net debt to recurring EBITDA ratio to 3.5x pro forma. This metric is significantly lower than historical figures, which were previously cited in the range of 5.0x/4.3x. While ratios below 3x are generally considered optimal, achieving 3.5x while simultaneously funding a high-volume investment pipeline, approximately $1.5 billion, is highly effective. This achievement demonstrates sophisticated financial management and the successful application of the company's equity funding component, 75% of capital structure. The reduced leverage reinforces the A rating, ensuring stable financial flexibility regardless of shifts in capital markets. 4.3. Capital Structure and Maturity Schedule. ADC maintains an exceptional liquidity position, holding over $1.9 billion. Crucially, the balance sheet exhibits minimal refinancing risk in the near to medium term, as the company faces no material debt maturities until 2028. This structural stability shields ADC from the volatility associated with short-term interest rate hikes and positions the company to continue executing its growth strategy without the distraction or expense of immediate refinancing cycles. V. Growth Strategy and Execution. 5.1. Capital Deployment and Acquisition Pace. ADC's management team has displayed significant operational confidence, demonstrated by the aggressive increase in capital deployment guidance for 2025. The company raised its full-year investment guidance to between $1.5 billion and $1.65 billion, representing a 65% increase over the previous year's volume. Execution remains strong, with $450 million deployed across its 3 investment platforms during Q3 2025 alone. Despite the high volume of deployment, the company has maintained rigorous pricing discipline. Management commentary highlighted that they have declined certain large acquisition opportunities due to concerns over pricing. In the context of the tight net lease market, where cap rates are struggling to keep pace with the rising cost of capital, this disciplined approach is critical. It shows that ADC is prioritizing the quality and accretiveness of its spreads over simply maximizing transactional volume, ensuring that shareholder capital is deployed highly efficiently. 5.2. Diversified Growth Platforms, Development and Partnering. ADC strategically augments traditional acquisitions with diversified growth mechanisms, including partnering with private developers and utilizing its internal development platform. This strategy is explicitly designed to generate superior returns compared to those attainable via external acquisitions. The development platform allows ADC to essentially manufacture assets at a higher yield on cost than the prevailing market cap rate, effectively creating an acquisition arbitrage opportunity. For example, during Q3 2025, ADC commenced construction on its first 7-Eleven developments in Michigan and Ohio. By controlling the creation of high-quality, long-term net lease assets, this strategy serves as a structural solution to the problem of compressed external acquisition cap rates, directly supporting the company's ability to sustain high AFO growth rates, 7.2% year-over-year. V. Dividend Policy and Safety Analysis. 6.1. Dividend Mechanics and History. ADC differentiates itself in the market by paying a monthly dividend, a structure highly valued by income-focused investors. The company demonstrates commitment to shareholder returns and financial stability through its history of 4 consecutive years of dividend increases. The current annual dividend stands at $3.07 per share. 6.2. Payout sustainability, correcting the gap distortion. An essential element of REIT analysis is correcting the apparent distortion caused by traditional accounting metrics. The reported payout ratio, calculated using GAAP earnings per share, EPS, appears concerningly high, ranging between 167.6% and 174.06%. This figure is misleading because GAAP EPS incorrectly deducts real estate depreciation. The appropriate metric for assessing sustainability is the AFO payout ratio. By comparing the annual dividend per share, $3.07, against the midpoint of the FY 2025 guidance, $4.32, the true forward AFO payout ratio is calculated to be approximately 71.1%. A 71.1% payout ratio is conservative and indicates exceptional safety and sustainability for a REIT. It confirms that the company retains nearly 30% of its core operating cash flow internally. This retained capital is vital for funding future accretive investments and maintaining the investment-grade balance sheet, ensuring that the dividend is not only safe but also positioned for continued growth consistent with the company's 4-year track record. 6.3. Yield and growth estimates. ADC currently offers a dividend yield of approximately 4.21%, positioning it competitively within the income sector. Based on projections of continued dividend increases driven by sustained AFO growth, forward models estimate that the yield on cost for existing shareholders could reach 5.16% by 2028. V. Valuation and investment conclusion. 7.1. Valuation methodology, P by AFO. The valuation of ADC must rely on the price to AFO, P by AFO, multiple, which is the institutional standard for REIT analysis. This metric provides a clear comparative measure of value based on stabilized recurring operating cash flow, bypassing the shortcomings of GAAP earnings. Using the approximate market price of $72.87 and the revised FY 2025 AFO guidance midpoint of $4.32, the current forward valuation is derived as follows. P by AFO equals, shown on the screen, approximately 16.87x. 7.2. Peer multiple comparison and justification of premium. The current P by AFO multiple of 16.87x represents a premium valuation, which is justified by ADC's fundamental strengths. The superior quality of its assets, 67+ IG exposure, low leverage 3.5x pro forma, and A credit rating mandate that ADC trade at the higher end of the net lease REIT spectrum. The average Wall Street analyst price target is $82.21. To reach this target, based on the 4.32 AFO guidance, ADC would need to trade at an implied P by AFO multiple of approximately 19.03x, $82.21 divided by 4.32 AFO. The path toward the consensus target of $82.21 will be driven by continued multiple expansion from the current 16.87x toward the implied target of 19.03x. This expansion is expected as the market continues to recognize the successful execution of the aggressive $1.5 billion investment schedule and the enhanced risk profile resulting from the improved leverage and A credit rating. The company's exceptionally low beta of 0.55 further suggests stability and a reduced correlation to broader market volatility, making it an attractive defensive asset during uncertain economic cycles. 8. Conclusion and investment recommendation. Agree Realty Corporation, ADC, presents a compelling investment case uniquely combining a defensive, high-quality income stream with a high-growth execution capability. The company has successfully established an industry-leading balance sheet characterized by its A credit rating and significantly improved leverage profile, 3.5x net debt EBITDA. This financial strength facilitates a disciplined, high-volume investment strategy, 1.5B to 1.65B guidance, that employs development arbitrage to maintain superior investment spreads, even as macroeconomic conditions challenge the net lease sector. The portfolio quality, underpinned by 67% IG exposure and 71.1% AFO payout ratio, ensures the monthly dividend is highly safe and sustainable. Although ADC trades at a premium P/AFO multiple, the company's superior financial characteristics, risk mitigation strategies, and proven operational discipline warrant this valuation. The current share price offers a tangible path toward capital appreciation as the market aligns the stock multiple with the superior risk-adjusted growth demonstrated by management.